Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome to the Ask Ralph Show. Thought I'd take a few minutes now to talk about some year-end tax planning ideas for individuals and businesses. Now listen, right now there's a huge discussion going on in Washington, and I don't have a crystal ball, so I can't tell you what's going to happen. But there are some things that I think you could take a look at doing before the end of the year that might give you some benefits going into the new year. The first thing is, if you've got a broker and you've got some stock losses, it might be a great time to talk to your broker and take advantage of some of those losses to offset against any capital gains you might have. And I don't want to get into a huge discussion about this, but I always mention this to my tax clients. If you've got a broker that handles your finances or your investment portfolio, you really need to be talking to them at the end of the year and looking at some ideas of how to handle some investment decisions that you could make that might benefit you on your taxes. In general, for most people, the key right now is to postpone income until 2018, but accelerate deductions for 2017. This is going to be especially valuable if Congress gets themselves together and actually passes lower tax rates next year. If they do, then a lot of the things that we're going to talk about here may get phased out. These include child tax credits, higher education tax credits, and deductions for student loan interest. All these things are supposedly on the chopping block. So if you can use them this year to reduce your taxes, it would be a great idea to do that. In some cases, you might not want to do that. For example, it could be that your filing status is going to change and it's going to be more favorable in 2018. So you need to take a look at those things and consult with your tax advisor before you make those decisions. Right now, I'm getting a lot of calls and emails about converting a traditional IRA to a Roth IRA. If you've got a traditional IRA that has lost money or it's got beaten down stocks, it might make sense to convert that money to a Roth IRA. But just remember, whatever conversions you do, that adds to your income in 2017. Now, there's one thing that a lot of people don't know about that you might be able to consider here. Let's say you've already done your Roth conversion and you've seen your Roth investments go down in value. That would potentially trigger you having to pay tax this year on a higher amount than the value of those portfolio assets. What you're able to do, and you have to talk to your broker about this, you can back out of those transactions by recharacterizing the conversion. What I mean by that is transferring the converted amount plus earnings or minus losses from the Roth IRA back to a traditional IRA via trust to trustee transfer. And then you can always convert it back to a Roth later on. Another strategy to employ here at year end is to arrange with your employer to defer until early 18 a bonus. If you've got a bonus that you've earned, try to talk your employer into putting that bonus into the next year. This will also help you if Congress doesn't reduce the tax rates moving forward. Another thing I always advise my clients to do is consider using a credit card to pay deductible expenses before the end of the year. Even though you may not pay that credit card bill until after the end of the year, it really gives you an opportunity to what we do call bunching up some deductions. If you owe state and local taxes when you file your return next year, consider asking your employer to increase the withholding of state and local taxes or pay estimated taxes. Whenever I have a client that pays state estimated taxes, I always encourage them to make those tax payments before the end of the year so that they will become a deduction in the current year. Now, this is very important now because a lot of the discussion in Washington centers around some decisions about whether they're going to eliminate state and local tax deductions or property tax deductions. If they do eliminate that, this will be the year to take advantage of that. You also want to make sure that you take a eligible IRA distribution if it makes sense to do so. And what I mean by that is, let's say that you are having less income this year than you expected. Well, it might be a great time to take an IRA distribution to match against the deductions you have this year. You want to keep all these things in mind as they relate to alternative minimum tax at all. And I'm not going to get into that discussion because I will lose everybody and everyone will fall asleep. One of the things we talked about a moment ago was bunching your transactions or bunching your strategies together. What I mean by that is if you've got a lot of medical expenses this year, go ahead and pay those by the end of the year or prepay for some treatments that you're going to have in the next year so that you can get to those thresholds, like for example, the medical being a 10% threshold, or itemized deductions, prepay your mortgage interest, prepay your property taxes, do charitable contributions. All those type of things will help you. If you're looking on a casualty loss, consider settling that casualty loss before the end of the year so you can take a deduction for that. If you're in the position of being at over 70 and a half and you've got to start taking your RMDs, your required minimum distributions, take a look at that. So what I'm talking about here is in the year that you turn 70 and a half. So let's just say in 2017, you turned 70 and a half. You don't have to take that RMD that year, but you might want to, because if not, in 2018, you're going to have to take 2 of those. So again, this is all coming down to try to limiting that income in the current year. You also want to take a look at your employer's health flexible spending and make sure you've got enough set aside for that. If you've used it all of this year, consider putting more in for next year. Take a look at health savings account deductions. You also might take a look at some gifts to give to your family members at the end of the year, because you get that exclusion of $14,000 per year to an unlimited number of individuals, but you can't carry this forward. So if you're doing some estate planning, make sure you're getting the benefit of that $14,000 per year for the people that you want to give these things to. And lastly, as far as the individual things go, if you're affected by Hurricane Harvey, Irma, or Maria, keep in mind you may be entitled to special tax relief under recently passed legislation, such as casualty losses. In addition, you may have some charitable contributions you can take advantage of. Now, on the business side, I think the big one is expenditures of qualified property. A lot of my clients in our meeting right now talking about, what can we buy in the area of equipment that we can get a deduction for? And that's because you basically can write off a ton of these things up to $510,000 for 2017. And this is an area where if you're going to buy that machine anyway, you might as well buy it in 2017. Even if you buy it on the last day of the year, you're going to get that full deduction for 2017. So keep an eye on this. This may help corporations as well if they think their tax rates are going to go down next year. Even more reason to buy those things now. And that's why you'll see a lot of equipment companies really trying to push sales here at the end of the year. Well, I'll keep you updated as this thing moves through Congress, and maybe I'll have some more concrete information in a future show. I hope these things help.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.